Oxford BioMedica has cut its 2026 revenue guidance to 180 million to 200 million pounds, sending its shares down 18% to 487.5p. The evidence currently points more to a timing and execution shock than a collapse in demand for cell and gene therapy manufacturing. But a large client has changed its procurement strategy, so the reports do not yet establish whether this is merely delayed revenue or a lasting reduction in future work. Recent coverage presented a growth story with an execution warning. First-half revenue rose about 9% to roughly 80 million pounds, and the company reported record client wins. Yet the guidance cut also revived concerns about previous forecast misses, making the slower-than-expected ramp-up at its Durham, North Carolina facility particularly important. The direct mechanism is straightforward. Client program deferrals and delayed timelines push expected revenue beyond 2026. A later operational ramp means the new site can Oxford BioMedica to absorb its operating base against a smaller near-term revenue stream. That helps explain why the company still expects only a mid-single-digit EBITDA margin this year, excluding one-off costs. There is meaningful counter-evidence to the harsher interpretation. Around 165 million pounds of forecast 2026 revenue is covered by contracted client orders, while the total revenue backlog is about 193 million pounds. Those figures suggest that the immediate problem is converting and timing work, rather than proving that the order book has disappeared. They do not, however, settle when that revenue will be recognized, or what margins it will earn. The more uncomfortable reading is the procurement change at a large client. That is not simply a 6-month construction delay at Durham. It may reflect how a customer is planning its manufacturing demand. The available reports do not identify the client, quantify the affected program, or say whether the change is permanent. That leaves the central question unresolved. Can Oxford BioMedica convert its backlog once the site ramps, or is the business losing part of the growth it had previously expected? For holders, the important reconsideration is whether the investment case depends on clean 2026 delivery or on longer-term capacity and client growth. For watchers, the 18% fall does not by itself distinguish a cheaper growth stock from a company whose forecasts remain unreliable. The next useful evidence will be revenue and margin progress, Durham's ramp-up, and whether the maintained 25 to 30% revenue growth guidance for 2027 is actually delivered. The strongest current judgment is that Oxford BioMedica has suffered a serious execution and timing reset, with structural demand damage possible but not established. The reports do not quantify how much of the shortfall comes from deferrals, procurement changes, or the Durham delay. Until backlog conversion and 2027 growth provide that evidence, the stock's central uncertainty remains unresolved.